think we'll get started. Hi, everyone. Welcome to Vicente's ESOP webinar. My name is Jeremy Shaw. I'm a partner in our Boston office in our corporate group. I'm joined by two really excellent professionals who specialize in the ESOP space, Andrew Nikolai from CSG Partners and Tali Newman from Morrison Cohen. We're going to go through some of the basics of the ESOP transaction, business structure, some things to keep in mind if you're exploring it, and how it's can be unique for cannabis businesses, as well as the benefits just generally. I'm going to let Tali and Andrew give some introductions. I had the pleasure of working with them, both of them recently on a couple of transactions, and both the wealth of knowledge here. So Andrew, why don't you go ahead and start, and then Tali, you can introduce yourself as well.
Yeah, thanks, Jeremy. Hey, everyone. Andrew Nikolai here with CSG Partners. CSG Partners is a boutique investment bank based in New York. We've been around for about 25 years and have done over 300 in ESOP transactions. So we've done ESOP transactions in virtually every other industry and just started kind of focusing and working in the cannabis industry over the last year or two.
Hey everyone, I'm Tali Newman. I work for Morrison Cohen, LLP. We are a mid-sized law firm. We really have expertise in all areas, and we have a strong ESOP group here. Been working on ESOPs for around 15 years, and we've done I would say hundreds of them in all areas, and just started working in the cannabis industry and really excited about what is in store.
Awesome, thanks. A lot of you probably know Vicente, but for those that don't, we're a cannabis-focused law firm, now cannabis and psychedelics. We represent businesses in the cannabis, hemp, ancillary spaces, burgeoning businesses in the psychedelic space, and we've started working with ESOP professionals on these transactions, some unique benefits for cannabis companies, and just largely a good business structure and transaction structure to keep in mind for our clients. Today, we'll talk about what employee stock ownership plan is, how it works, the benefits, characteristics that make it uniquely suited to a cannabis business, and then what it looks like to get that done, and also some of the specific regulatory steps that you'll need to take to get that approved. I'll start by jumping in. We're going to have a few discussion points. I think we're going to structure this as basically a free-flowing discussion. I'll have some slides up with some of our talking points. We may diverge from those. Folks are encouraged to put questions into the chat, and we'll try to address them as they come in if it flows with the conversation. Otherwise, we'll have some time at the end to answer questions. All right, so just to dive right in here, and Andrew, I'll start with you. What is an employee stock ownership plan? What are some of the highlights that people should know in terms of what this structure looks like, and how it affects your business?
Yeah, so an ESOP at the end of the day is a retirement plan for the benefit of employees, similar to a 401k in some sense, except it exclusively invests in the stock or the equity of a specific company. So it doesn't, you can't invest in publicly traded stocks. It's the stock of a privately held organization. So at the end of the day, it's another way for a business owner to sell their stock or their equity in the company, and they're selling it to their employees. So instead of selling it to a strategic buyer or financial buyer like a private equity firm, you're selling the company to your employees. So the way that it works is there's a trust that's set up, and that becomes the buyer in this transaction, and all of the employees are beneficiaries of this trust. And so the company will go out and hire an ESOP trustee, who then hires their own valuation advisor and their own counsel, and that becomes sort of the buy side of the transaction. and then myself, Tali, Jeremy will advise on the company side, the sell side of the transaction. And so, the trust, we negotiate the transaction, all of the terms, and all of the stock that the ESOP buys goes into that trust and gets given out and allocated to employees over time.
Excellent, thanks. Talia, if you had anything to add, and then also we can get into some of the benefits and yeah, go for that.
I was just going to say just what Andrew said, except the ESOP is like a 401k plan, like Andrew said, and it invests only in your employer's stock. And there's different ways to finance the ESOP. So that ties into how the stock is allocated to participant accounts.
And Talia, maybe it'd be helpful to get into this a little more into the transaction side, but what are the different ways that these are financed? Because obviously, you're going out and hiring a fiduciary. They're not a buyer coming to the table with money. So what are the ways that you typically see these transactions financed?
There's a few ways that we typically see the ESOP transactions financed. The most common is the ESOP basically borrowing the purchase price from the sellers. So the ESOP acquires the shares and gives notes to the sellers or the prior owners of the company that say, I owe you this purchase price that, as Andrew mentions, negotiated between an independent trustee and an independent valuation advisor. Sometimes you do see a company going out to the market and borrowing money from a bank and lending that money to the ESOP, which the ESOP then uses to pay some cash, some or all cash, to the sellers. And Jeremy, maybe you could jump into whether that's feasible for a cannabis company to do.
Yeah, so for cannabis companies right now, that's difficult to impossible. Certainly as federal policy changes, that may open up. But right now, the cannabis ESOP transactions that we've seen are going to be financed, seller financed with notes, potentially with some financing to the extent the company has money to make that loan to the trust itself. But hopefully in the future, it becomes more readily accessible for cannabis companies to find debt financing. Tali, maybe you could get into, first of all, some of this legal specifics on, how these companies are taxed, what the structure looks like, the S election, and how that helps sort of unlock the tax benefits of being owned by an ESOP.
Right. So for any business, of course, being exempt from federal tax is a huge benefit. When you have an ESOP that does not pay taxes, and then you have the ESOP acquire a company which then elects to be treated as an S corporation and have the tax flow through to the shareholders, if the shareholder doesn't pay tax, that is helpful for any business to kind of keep income that would otherwise go to pay taxes. In a cannabis company, due to Code Section 280E, that's beyond helpful. It just kind of maximizes the benefit that any other entity would benefit from not paying taxes. So, and Jeremy could probably talk more about 280E and what the future holds or doesn't hold, but the benefit, or if you have a crystal ball, but the benefit is, of course, to be tax exempt at the federal level and thereby no longer being subject to 280E for cannabis.
Yeah. And, I don't have a crystal ball. I think we're all sort of waiting and anticipating shortly, whatever that means to everybody, some movement on rescheduling, which would eliminate 280E. In the meantime, we're still where we are, and I think it's a massive benefit. I think even putting that aside, obviously avoiding paying income tax is going to be a big benefit no matter what for your business. And it's an important structuring point. So just to restate it, the ESOP as a trust as a benefit plan does not pay any tax. And so if the company makes the S election, becomes passed through to the shareholder being just the trust, there's no tax owed. It's really I got to say, the first time I heard it, I could hardly believe it, especially for a cannabis company. But that's how it works, and it's really a great benefit. Andrew, maybe you want to feel free to jump in with any further comments there, and also maybe to talk a little bit about the benefits with regard to employees and what it looks like on their end.
And I just want to cover quick. I see there's a question here just on the financing side of things. So like Tali said before, there are a couple lenders out there, banks, also, some private lenders that do participate in the cannabis industry. Banks are certainly very limited. So, there's a couple that we've spoken to before and explained the ESOP structure. And yes, we may be able to get some financing. It's been generally challenging so far. There's some private lenders as well that would probably be willing to give a little bit more leverage or cash at close, but they're also going to charge for it. So that's sort of the trade-off. One thing we've done in some of our prior transactions is we can go out and survey the market, get some term sheets in from the lenders, and then the owners and the business owners can decide, is that something they want to pursue or not. So I guess getting into maybe some of the other benefits, because I know we talked about the tax-free nature, and basically you have the ESOP trust is a tax-exempt retirement plan, so structured as an S corp. All the taxable income flows through to the ESOP, which is tax-exempt, and so that's how you avoid paying taxes. On top of that, there's a benefit for the selling shareholders. They can elect what's called Section 1042. It's very similar to, if anyone's familiar with 1031 in real estate, where you sell an asset and within a certain period of time, roll over the proceeds into a qualified reinvestment. Section 1042 is the equivalent for ESOP transactions. So if you sell stock to an ESOP within 12 months post-transaction, subject to certain reinvestment requirements, you can actually avoid or defer paying capital gains taxes on the sale. And there's also ways to structure it that you can completely eliminate those taxes over time. So another benefit of these transactions, personal to the selling shareholders, is the ability to defer and potentially avoid paying capital gains taxes. I think the last benefit I would point to is just obviously on the employee side, right? The reason that there's so many of these benefits built into the tax code that maybe sound too good to be true is because everyone, pretty much unanimously agrees of how powerful the benefits are when you share employee, ownership with a broad base of employees. You get benefits on, the hiring side in terms of offering another benefit to employees that maybe your competitors aren't. On the retention side, all employee benefits are typically subject to a vesting schedule similar to a 401k. So that can help certainly retain employees for a longer period of time and, improve turnover. There's been a number of studies that have been run on ESOP companies and comparing them to non-ESOP companies, and just, comparing what sort of productivity gain you can get when all of your employees now, feel like they have an ownership stake in the company, and they do, and, feel like everything they do on a daily basis directly kind of impacts the value that they're holding. So certainly, I think it's a little bit more obvious, but the huge impact that you can make in terms of sharing equity with your employees.
It's also a really good way to succession plan, or it can be a good way to succession plan, depending on, whether there's a market for your business, like a third-party market for your business, depending on how kind of close you are to your employees and whether you feel that you want to pass on, the business to people who have been with you for a long time, versus kind of like shut down or sell to a third party or an investor in the event that the sellers or founders are aging and kind of want to move on. So that's another kind of aspect to consider.
Yeah, absolutely. And while we're on that topic, I see a question about how the sort of beneficial ownership is allocated to the employees. Tali or Andrew, can you give a little bit, and we don't need to go into all the details, but some of the mechanics there?
Yeah, I would say at a high level, employees are allocated shares based on each individual's salary as a percentage of total company salary. So, roughly speaking, someone making $50,000 is going to get half as many shares through the ESOP as someone making $100,000. Every plan has to be non-discretionary, and shares have to be allocated out to employees, equally based on their percentage of payroll.
Excellent. And I know I just want to hit some of these things in the same question while we're here. In terms of how much is sold to the ESOP, what are your options in terms of structure? The question here was, does 100% need to be sold in order to eliminate the income tax? And then probably also worth talking about some of the structuring, the warrant structuring for upside to the sellers going forward.
I can take that. So Andrew mentioned Code Section 1042, which is a way to defer or to avoid paying capital gains on the proceeds of the sale. In order to elect 1042, you have to sell at least 30%. 30% of the company has to be sold to an ESOP. So the transactions that we see tend to range from 30% to what we call 100% ESOP, which this question says, does it need to be 100% ESOP in order to elect S? So no, it can be less than 100% ESOP to elect S, but in order to get the tax-free status, the ESOP has to be the sole or like the majority 99.99% shareholder. So for cannabis business, it like the real benefit is being or losing the requirement to be subject to 280E, and so you would probably need to see that 100% S ESOP held S status. So unless Andrew or Jeremy disagree.
I would say you need the ESOP to own 100% of the outstanding stock, but like Jeremy said, there's ways to structure, some synthetic equity, for example, in the form of warrants. And so what that allows you to do is maintain or retain, pretty significant economic ownership stake. And those warrants, as long as they're never exercised, you never have any taxable income flow through to the warrant holders. And so for tax purposes, you can create a structure where the ESOP owns 100% of the outstanding equity, but you can still retain, economic ownership without, impacting your tax status.
Yeah, I think that would be a good time to talk about some of the regulatory restriction of ownership and how that's disclosed. So certainly if you have the trust coming in and owning 100% of the company, an obvious question for anybody who has a cannabis business is, okay, well, what's happening with the regulators, and who needs to be disclosed to the employees who are beneficiaries of the trust and disclosed? The answer is going to depend on what jurisdiction you're in. Certainly the trustee, I can't imagine any jurisdiction where the trustee is not going to need to be disclosed or background checked. Now, there are professional fiduciaries that you can hire, and typically in this transaction, you would hire that person at a minimum to handle the transaction. There are regulations around the way this transaction must be structured so that it's a fair transaction, and you want a professional fiduciary handling that piece of it. There's going to be some of those requirements later too, but for regulatory purposes, if whether your jurisdiction is going to be impossible for you to get that professional fiduciary to stay on, whether there are license caps that might knock out the not particularly large universe of folks that do that type of work. you can have an internal trustee. So that can be somebody who's already on your license, sit in as the trustee post-closing for the purposes of that. Now, you may want to hire, it's probably advisable to hire a special fiduciary who is versed in all the ESOP reporting and everything that goes along with maintaining the ESOP structure to advise on certain, business sort of structural and ESOP matters. But from that perspective, you can do that. Now, it's going to be a typical, it may be a typical change of ownership process to get the trust itself approved. And then whether there's an individual who's serving as a new trustee, getting fingerprinted, background checked, may or may not be the case, depending on if you have an outside trustee or the jurisdiction. In terms of the employees, again, that's going to be jurisdiction based. I would say a large number of jurisdictions will not go down to beneficiaries of a trust, particularly at the levels of beneficial interest in the company that each employee would have. Likewise, with respect to any selling shareholders that hold warrants, if your jurisdiction has regulations that pick up convertible securities as current interests, you may need to, I guess it would be leave them on the license, assuming they already were on the license, given their status as holding warrants. So that a lot of that's going to be on a case-by-case basis based on your jurisdictions. Maybe you have multiple jurisdictions to deal with. But it's a good thing to address up front and work with people like me and Andrew and Tali to think about the best way to structure things to get a transaction done smoothly. Let me see if there are any other questions on this
so just
topic.
to reiterate, because I think there were a couple of questions. Most likely, you're not going to need to go down to the employee level. Obviously, it depends state by state, but none of the transactions we've done so far, because the employees are getting beneficial ownership instead of true equity ownership in the company, most likely you will not need to do any sort of additional background checks or anything like that on the employee level. I saw a couple questions just on the structure. So just to clarify, the company is the one that's implementing the ESOP plan. And in order to do that, you have to be a corporation. So either an S Corp or a C Corp. So you can't be an LLC. So that rules that out. And so I guess the tax advantage, you have to be an S Corp to get the tax-free status, because C Corps are going to pay taxes at the corporate level, whereas S Corps have all their taxable income flow through to the owner. And when you have the owner being a tax-exempt ESOP, that's how you can really implement that tax-free status. So the company is the one that's converting to an S Corp, and then the ESOP is really a shareholder of that company. They're not necessarily, the ESOP is a trust. It's not a C Corp or an S Corp or an LLC. It's really the shareholder of the company.
Thanks, Andrew. There are a number of other questions coming in, and I'm going to keep moving on to what we have lined up for discussion points. We'll come back to some of the other ones, time permitting at the end. Andrew, maybe you could take this one. I think a lot of people are probably wondering, okay, so when would this type of structure apply? Would it ever apply to my business? And maybe you can answer this, feel free to go outside of cannabis and just your typical ESOP experience. What are the types of businesses that you see doing this? What stage of the business? What size? Things like that. Is the sort of the norm? And then you can also talk about what's possible and things.
Yeah, it's a good point. Just so everyone knows, a lot of what we're discussing so far, we're, specifically kind of talking about the cannabis industry here, but it really applies to every other industry as well. It's not unique just to the cannabis industry. So in general, I would say, most of our clients are more mature, stable type of businesses, typically family owned, founder run still, or, someone in the family is still running the company. Generally, businesses that are still earlier stage. So no matter what, right, the cannabis industry as a whole is still in its earlier stages. So any business in the cannabis industry is going to be earlier. on in its life cycle probably than our clients outside of the cannabis industry. But that being said, think about states, for example, like New Jersey or some other ones that really have just started, having cannabis businesses open. It's probably a little bit early to consider an ESOP transaction, right? If you're still kind of in that investment mode, you see a lot of growth coming up and, a lot of potential earnings, but haven't really had a chance to recognize that yet. You're probably going to be leaving a lot of value on the table if you look at, selling the company this early. There's also some kind of some other challenges when the business is too small. For example, we typically tell people you need to have at least 20 full-time employees that would be participating in the ESOP to avoid, there's basically anti-abuse provisions in section 409P. And so to avoid any issues with that, we typically like to say 20 full-time employees. So, and full-time employee is usually defined as someone who works a minimum of 1,000 hours in a year. And so, for cannabis businesses specifically, a lot of your part-time employees may not be eligible to participate. And so it could make it challenging if you don't have enough employees. And the last thing I would just mention is, you're going through a sale transaction. There's professional fees involved upfront to put the plan in place. So, and some cannabis businesses are running relatively lean with the competitive environment they're in, with 280E and the high taxes that they're paying. The ability to kind of build up enough cash to be able to implement the ESOP upfront, I would say, can be challenging for some businesses that are smaller. And so generally, rough numbers, I would say you want to think about earning a business that's earning a couple $1 million a year would be kind of at the low end to consider a transaction like this.
Thanks, Anna. That's really helpful. And another thing that I'm sure people are wondering about, and is obviously a bit different than your typical M&A transaction, is, okay, so what does the post-closing company look like? What does management look like? And I think another piece, sort of unrelated, but what are the post-closing obligations with respect to the ESOP? And that speaks to some of the sort of ongoing fiduciary obligations that exist. Tali, I don't know if you want to take some of that.
Yeah, sure. So post-closing, the company looks a lot like it did pre-closing. And I think that for a lot of people, that's a benefit. You have the same people in charge. You have, the same management. A lot of times in 100% ESOP transaction, like you would contemplate for a cannabis company, the trustee will negotiate for some covenants, and that might include an independent board member who can kind of sit in and kind of make sure that the sellers are, treating the company as though it does have a new outside shareholder, which it does, which is the ESOP. But generally, kind of things, go back to normal, and once the transaction is complete, the prior management continues to run the company. But there are, new requirements that the ESOP will want the company to comply with, and also that the company will have to do like 5,500 filings. There's going to be a requirement for annual valuation updates so that the participant shares can be valued. There's going to be requirements for summary annual reports to go out to participants. There are requirements consistent with the fact that the ESOP is a qualified retirement plan. And that's why you have, in addition to your outside trustee, and, to the extent that regulatory approval becomes an issue and the external trustee can't stay on, we would encourage internal trustees or the company that has an internal trustee to engage a special fiduciary to advise it with all things, trust related. And something that we didn't mention was that in addition to the trustee, there is the company would need to engage a third party administrator to figure out what shares are allocated to which participant accounts, and kind of on an annual basis, what's released to which employees and what's vested and not vested, the same way that you have an administrator who administers your 401k plan, like a principal. There's a few ESOP TPAs that we work with, whom are all very good, but that is another thing to consider and another cost.
Yeah, it's
Yeah.
sort of related to the. Oh, go ahead, Andrew. If you want to add.
I was just going to add that basically the trustee is a passive investor. They're not going to come in and kind of tell you what to do or how to run the business. Really, what they care about is looking out for the best interests of the employees, and generally letting the management team, the board of directors, and the people that have spent the past X number of years building up the business and the value that you're selling are the best people to continue running that business going forward. So I just want to make sure that's clear. They're not going to come in, hire, fire, tell people what to do. They're really more of a passive investor that's going to kind of trust the board of directors to continue operating the company in everyone's best interests.
Yeah, absolutely. In terms of pitfalls or risks that things to keep in mind when you're engaging in this ESOP transaction, obviously, as a benefit plan, it's heavily regulated. Cannabis companies know about being heavily regulated. What are the things, particularly when you're engaging in this transaction, that you need to keep in mind? And sort of what I have in mind is, first of all, making sure you're going through the process to hire the trustee. You're doing that the right way. You're hiring professionals like us to guide you on, really you're negotiating this at arm's length, like an M&A transaction. What are some things that you'd suggest to people when they're getting into this, as they're beginning it, to avoid some of those pitfalls? And what do some of those risks look like for a company?
I mean, I can start just from kind of comparing to an M&A transaction. In an M&A transaction, generally, when there's just a non-ESOP buyer, there's an allocation of risk between the buyer and the seller. Here, that it's kind of like market. What would be market for to be the buyer's risk? What would be market to be the seller's risk? In an ESOP transaction, the seller is literally creating the buyer. The buyer has no money. It doesn't really have any means beyond contributions from the employer, and the employer pays its fees. So it's not like a typical. I don't think you can go into it with the mindset of take it or leave it, or playing hardball. Like that doesn't work to anyone's benefit in the ESOP deal. It needs to really be kind of arm's length and fair to the ESOP, and with the mentality that like the ESOP is not engaging like KPMG to do its tax diligence. Kind of like everything really does need to be disclosed and on the up and up, in everyone's best interest, in case there's a DOL or an IRS audit. It needs to be kind of really well documented, and really just truly fair to the parties. Not to say that like the ESOP needs a windfall, but just it needs to be kind of fair. Like it should be paying a fair market value price and not more than that, and just really things of that nature. And I think that that's important to recognize prior to starting out. It's the ESOP is really not getting, and the trustees are really not getting any like benefit or leg up on the sellers for getting like what a seller would deem to be a too low price. It's really just they're just really looking out for the process and for the optics and what looks to be fair.
And I think around the fair price also speaks to sort of what stage of my business makes sense to engage in this. Like it's not, you don't necessarily want to do this type of transaction at a stage where maybe a third party buyer in the market may be looking at, hey, I see the huge benefits of this going up that are different than what you might see in a more conservative analysis, like business analysis of the company that's being acquired. So I think that it kind of dovetails there.
Yeah.
Andrew, anything else you want to add
I
in
was just going
terms
to
of
add,
the,
yeah, that basically all ESOP transactions are subject to oversight by the Department of Labor, like Tali was talking about. And so really, one of the primary things to think about when you're going down the path initially of an ESOP is just making sure that you're kind of running a process the right way, right? We've done a lot of these. We know what to do, what not to do at this point. And so, the sellers ultimately are going to kind of be at risk of that oversight. If the Department of Labor comes in and audits the transaction, you want to make sure that things were done properly to reduce that risk and any potential, liabilities in the future. The Department of Labor wants to make sure that the ESOP trustee paid fair market value. And so, just that's probably the primary thing I would mention to keep in mind is you want to make sure that you're not trying to, provide unrealistic projections or something like that would ultimately push the value and the price that you're able to sell the company for above what would be considered reasonable, because all of these transactions are subject to that oversight at some point.
It also I wouldn't say it's a pitfall, but something to remember or to keep in mind is see there's a question about exercising options, and the ESOP is really not an immediate or kind of near-term benefit. It's really designed to be a retirement benefit that is designed for actual retirement. So it's not something that the employees are going to kind of in the next 3 years, cash out on. It's just that is not what the ESOP is. So I think sometimes if you have this expectation that the employees are going to be kind of getting incentivized in the near term, that is not actually the case with an ESOP. You really have to think about it as a 401k plan with penalties for well, first of all, there is no cash in the plan. There's, for the most part, it's employer stock, and there's really very specific finite times when the stock is monetized and actually distributed to participants, and it's not for a while down the road. So just another thing to consider.
yeah. And while we're on that topic, is a little bit off the current topic, but about that piece, I saw some questions about, what's happening when employees are leaving. So Tali or Andrew, in terms of employees, they've been participants, they leave the company. What does that look like for them in terms of, what they've received as participants in the plan?
Yeah, I think I would start. Yeah, go ahead, Tali.
No, go ahead, Andrew.
I was just going to start. I don't think we talked about this yet, but all of the stocks that the ESOP buys initially goes into what's called a suspense account and gets allocated out to employees typically over something like a 25-year period, which means you're allocating 4% a year, and it takes 25 years for all of the stock that the ESOP has purchased to actually be given out to employees. And so it's not like there's some huge windfall, the day after the transaction, the employees are going to leave the company and walk away with all of this value, right? It takes a period of time, and it's also subject to that vesting schedule that we talked about prior. And then, there's ways to kind of, so once the employee leaves, so each year they're going to get a statement that says they have this many shares and this is the price per share, and it's all held in stock. And when the employee leaves the company at some point in the future, that's when they have the right to sell that stock back to the company. And that's what converts that stock into cash.
And that's plan dependent. But for the most part, or for a lot of the times, that vested account balance will just kind of sit there. And there's, periods where they can be paid out, and there's rules regarding whether the stock is subject to an acquisition loan and the type of termination it is. So it really varies plan by plan and situation by situation as to kind of when they can get that stock turned into cash and distributed. But then once it is distributed, it's also subject to an excise tax to the extent it's not rolled over into an IRA. So there's a lot. That's kind of like a meaty question, but for the most part, they're not going to really see kind of cash at termination unless it's an actual retirement, and that's as defined in the plan. And if you do go down the ESOP road, we do sit down and kind of talk about all of the options as to like, how do you get paid? How do you vest? How are the shares allocated? What are the participation requirements? Things like that. And cannabis companies, like I saw in the chat, there is a lot of turnover, and that is definitely something to take into account when you're designing your ESOP. Like, do you want more participants in earlier, or do you want to make them have to wait and then like vest quicker? There's a bunch of considerations that go into it.
Excellent. So, next, in terms of preparing to for this process, I mean, I think obviously we just talked about all the stuff that's different from typical M&A. I think what's similar is, get a data room ready, get everything in order. You're going to be going through diligence like an M&A process, so be prepared to do that. Have your financials, ready to be vetted by your buyer. You're probably looking at them internally to come up with your own idea of what this is going to look like from a transaction value perspective. In terms of the process you want to go out and start talking to trustees, maybe you just quickly touch on, Andrew, maybe that process of forming a committee to interview trustees and things like that, and kind of what that universe looks like. Because I know that was new to me. Like, I know there's people who do this. It seems like it's not a huge universe, but there are folks that serve in this capacity. And what does that process look like?
Yeah. Usually when we start working with a business owner that wants to consider an ESOP, the first thing that we do is really, sit down, discuss objectives, what you want to achieve with it, and then model out all the different transaction structures that are available and figure out the best path forward. So that's sort of the first stage. Is if you're going to do an ESOP, well, there's a lot of ways to do it. So what's the best, way to structure it for you and your exact situation and your objectives? And then once that's been determined, that's when we would kind of move forward with selecting a trustee. So you would set up a ESOP trustee selection committee. Typically, you have a couple employees serve on that committee. You send out an RFP to a number of trustees. These are institutional trustees that primarily work on ESOP transactions. So that's their job. That's what their company does. They serve in that trustee role and negotiate the transaction on behalf of all the employees. And so they're going to hire their own financial advisor and their own counsel to help them, advise them on the transaction and help them negotiate the deal.
So, Tali, anything else either on that specific topic or just generally, what you'd like to see when a client comes to you, they're ready to start this process? What is like sort of the client that looks like as ready as can be look like to you?
So it's funny. It's just, and this is like across all kind of privately held companies, is you'd be surprised how kind of little corporate governance documents they have in place, like who are your officers and like where does it say who they are and where they were appointed and things like that always kind of are needed in any sort of transaction like M&A or ESOP transaction. A lot of times we'll be ratifying past acts, adopting bylaws, just like any just standard kind of corporate governance things that is great to just have in general. Like, do you have stock certificates? How do you know who owns your shares? Like, do you have a ledger? Do you have any sort of records? A lot of times companies don't. And so it's good to kind of think about getting that house in order before you kind of go out and start the process. Just it's good to have those things. And same with like leases, like just gathering all your papers together, because there are diligence requests, and it is just nice to have those things handy for when they're requested.
Yeah, excellent. All right, great. So next, I see we still have some questions in the chat and in the Q&A. I'll go through a few of these. Check in the chat. This is a question about what an exit, sort of a transaction out of the ESOP, I think is the question, what that would look like. If you have an ESOP in place and you want to sell your cannabis company, does an ESOP create problems for a clean or easy acquisition? But, Andrew, from what you've seen, what does that look like if an ESOP is going to sell? Is that an easy transaction? Is that a uniquely difficult transaction? And maybe also speaking to if there are warrants for the original sellers, what does that look like for them?
Yeah, I would say at a high level, putting an ESOP in place today doesn't restrict or change your options in the future. If you want to sell the business, at some point down the line, you essentially have a new shareholder, which is the ESOP, and the employees underneath. And when the company gets sold, they're going to get their share of the proceeds. So there may be some kind of negotiation with the trustee at that point in time. But basically, you have the ESOP owning a certain percentage of the company. You have the warrant holders owning a percentage of the company. Sometimes you have some other synthetic equity like stock appreciation rights. But basically, you still have that option down the line, and you're going to be the one that decides to go through with that transaction. And the trustee is then going to be in the position to negotiate what the employees get as part of that transaction.
That's right. And I'll just add that typically, and we have seen a lot of exits for ESOP companies, but typically the buyers will require that the ESOP be terminated. Buyers don't really want to keep an ESOP in place. And so that is a nice way for the ESOP participants to monetize their company stock.
Yeah. And sort of the terms of that, I mean, as you guys both know, are negotiated in terms of what that looks like and how many shares are out of suspense and what the transaction does to that. So there's a lot that is bespoke or sort of case by case, depending on how you want to structure the deal and also how it's negotiated with the trustee. There's another question: in a seller financed ESOP, the company or selling shareholders receive no cash, some cash. And again, I think the answer is it depends. If the company has excess cash available, it can serve as the bank to finance some cash proceeds at closing. Otherwise, there would be no cash changing hands at closing. It would all be in the form of the notes.
And one option, like we talked about before, getting ready for an ESOP, is maybe to consider converting to a C Corp sooner, and taking the time that it takes to get to closing an ESOP transaction to kind of build up excess cash, right? Most companies that are C Corp aren't making distributions because then there's 2 levels of tax. And so one thing to consider is maybe I make the C Corp conversion sooner and then just kind of build up all my excess cash for the next 6 months or whatever it is, and then I can use that cash to pay the shareholders portion of the purchase price.
See, another question is sort of transactional here. Please address typical remedies sellers have in event of default by the ESOP or the trust. I guess for sellers or buyers, I think typically it would be buyer. The transaction documents look similar to an M&A transaction. It's a purchase agreement with reps, warranties, covenants, and indemnification obligations. So it would look largely similar to an M&A transaction, and the sellers would indemnify the buyer. I mean, typically that's where you'd see the breach. So it would look a lot like your normal transaction.
Yeah, I agree with that, except I do think it's like slightly more favorable to the ESOP than it would be like in a market M&A transaction.
Yeah.
Buyer there, just because of what we discussed earlier, like the sellers really just knowing more about the business, like who would know if there was a litigation. The ESOP really wouldn't,
Right. You're not gonna be able to necessarily negotiate the type of terms that you would otherwise, and anti-sandbagging provisions, things like that. You might not typically get in there with an ESOP, and even if there's maybe not necessarily a breach of the rep, like you're worried about that on the sell side from the outset to make sure you're providing really fulsome disclosures and not sort of getting the best deal possible on the way the agreement's structured.
Yeah, and if the question was specifically about defaulting on kind of payment of, the seller notes, I would say most of the time you're still kind of involved in the business and on the board, basically still responsible for the operations. So, because of that, it's unlikely you're kind of putting the company in default if they're not paying you off, because you're the one that's responsible for paying yourself off, sort of thing. So it's a little bit of a weird situation, but point being, you kind of have control to run the business and, run the operations to make sure that you get repaid. And then, maybe once your seller notes get repaid, that's when you would think about, transitioning out of the business or something like that.
Yeah, thanks, Andrew. That makes sense, probably what the question was referring to. Let's see, I'm just going through here. One question, is it advantageous for the company to establish an ESOP if only to act as employee enticement? Look, I think when you see companies that say we're an employee-owned company, I mean, that's typically what this is. And I think there are benefits for your company broadly, just from a branding perspective, from giving your employees and from attracting talent. And Andrew, Tali, like, I don't know if you've seen, Andrew, you were talking about, studies about ESOP-owned businesses and what that looks like for them. But certainly it seems like a way to get some buy-in from your current employee base and potentially attracting more talent going forward.
Yeah, and potential, kind of a marketing benefit too, like you were saying, being able to put, that we're an employee-owned company could kind of benefit you on the revenue side as well.
Yeah. I think we've covered most of these. There's some other ones that appear to speak to some other items. Andrew or Tali, if you see one that I'm missing that you want to.
I see one. Yeah, I can cover the put option that employees have when they leave the company.
So,
yeah. Like Tali said before, each ESOP plan is unique. You have the ability to kind of set it up and structure it the way that you see fit. So there are ways to structure the payouts to employees when they leave over a period of time to avoid putting the company in the position where, there's a huge cash need that may be above what you have available. So generally, the best option from a cash flow perspective on the company side, you have the ability, if someone leaves today, you can wait a year to begin paying them out and then pay them out over a period of 5 years after that. So it essentially gives the company 6 years from the time an employee leaves to fully pay off the stock that they have in the ESOP account. So, those are kind of some of the structural items that Tali was talking about before that, need to be talked through and figured out what's the best plan for you.
yeah. Excellent. Well, Tali, Andrew, thank you for joining us here. It's really great to talk to you guys again and hear more about what you guys do. And, I look forward to our clients keeping this in mind. I think it's really interesting. It's really a beneficial structure that isn't always at the forefront of people's minds. So thank you everyone for joining. Our contact information is up on the screen now. If anything wasn't answered, you want to reach out, talk about anything, feel free, reach out to any of us. We'd be happy to chat.
Thank you.
Thanks, everyone. Have a good
Thanks, everyone.